So here's what I actually want to talk about today. The economy lost 92,000 jobs last month. Mortgage rates snapped back above 6% after breaking below that for the first time in basically 3 years. And real estate agents all across this country are being told, brace yourself, the spring market is right around the corner. Well, all three of those things are true, but what I find actually interesting this week is that almost all of them completely contradict each other. That tension is exactly what I want to break down today because if you're an agent trying to figure out what actually to say to clients right now, there's a lot of noise out there, and the signal on what we should be talking about is actually pretty hard to find. Okay. So that's what I do every single Sunday is help you break through that noise. And this week, especially, I want to take you through what I think actually matters and how we should be thinking about it. All right, real quick before we get into it, it's Sunday, it's early. I'm wearing what I went to bed in last night, and I am drinking coffee that I've already reheated twice this morning. And I'm not going to apologize for either of those things. So here's what I'm going to tell you. Every single Sunday, I sit down and go through the week's real estate and economic news, not for content, not for a show. Although, yes, I know I'm recording right now. I do it because of my gig. I carry an executive role in my real estate brokerage, and I need to actually understand what's happening in this market before I walk into a room full of agents, right? So I figure at some point, why not bring everybody along? And that's what we're doing here today. So if it feels like a Sunday sleepy morning conversation, that's because it is. All right. So let's get into it. Let's go. All right. So let's start with what broke this past week, and it was the jobs report, hands down the loudest story of the week. On Friday, the Bureau of Labor Statistics reported that the economy shed 92,000 non-farm payroll jobs in February, and the expectation from most was that we would see a gain of somewhere around 60,000. That's a huge miss, right? Well, now before anybody panics, let me give you the context that I think most are skipping over in this coverage, okay? So the healthcare sector alone lost 28,000 jobs, and that's because there's a ton of nurses that went on strike. Okay, that's important to know because that's not a structural job loss. Those workers come back when strikes end, and in this particular case, that strike ended before the end of February. We will see those jobs come right back in the March market, and then I'm sure it's going to be touted as a big jobs increase, but it's the same jobs, right? But here's the part that I think actually matters more than the headlines. Okay, the BLS also revised December 2025 from a gain of 48,000 jobs to actually a loss of 17,000, and the January came in a little bit light as well. What that tells us is that the labor market has been softer than it was reported for several months, okay? We weren't in a great jobs environment that suddenly broke. We were in a mediocre environment that got reported as a decent one. Now, on the other end of those reports are the wages. Average hourly earnings grew by 0.4% in February, and they're up 3.8% year over year. That is both above expectations and inflation. Employed people right now are keeping up. The problem is they're just not pushing forward just yet. Now we have the mortgage rates, okay? You probably saw last week that rates touched 5.98%, and that was the lowest since September 2022. Everybody was so excited. Okay? That was a huge psychological breakthrough that everybody had been waiting for. The week ending February 27th, we saw mortgage applications spike by 11%. Refinance applications were up 109% year over year. You heard that right, 109% year over year. The demand was sitting there dormant, and it came alive the second we crossed that 6% threshold, okay? Then this week, rates climbed back 6% and beyond, and that's because of Iran. Fighting escalated in the Middle East. Oil prices jumped to around $87 a barrel. Oil going up means inflation concerns usually. Inflation concerns mean bond yields go up, and when bond yields go up, mortgage rates don't fall even when job data says that they should. And that right there, that context, that's the blind spot, okay? And that's what I want to spend a little bit of time on today. See, in my opinion, here's the macro problem that nobody's really trying to explain clearly, okay? The Federal Reserve has two jobs. One is to keep inflation near or below 2%, and they're meant to keep unemployment numbers low. Right now, both of those goals are under pressure from opposite directions, okay? And here's what I mean by that. A weak jobs report normally says to cut the rates, stimulate the economy, right? But inflation running above target because of oil prices says what? It says do not cut, or you'll make the pricing situation even worse. Okay. The Fed is stuck right now. And when the Fed is stuck, mortgage rates do not move downward freely. Okay. There's a March 18th Fed meeting, and it's almost certain that they are going to hold the rates. Okay. Some Fed officials are even discussing whether we need to stay elevated even longer. That means the brief window that opened up at 5.98 last week is not necessarily a preview of where rates are going, but rather it may have actually signaled the low part of a downward trend for the near term. Okay. Now, here's where I want to be direct about something. The idea that rates dropping below 6% was going to miraculously unlock the housing market was always a wild oversimplification. And the data from this past week really just proves that. When rates hit 5.98%, mortgage applications jumped by 11%. That sounds great, okay? But 11% more applications off a historically low base is not the same as a healthy spring market. Homes are still sitting 64 days on the market, which is still the longest stretch in 6 years. Pending homes were still down 3.3% year over year. New listings in February were down 6.1% year over year, okay? The buyers who re-engaged when rates dipped were mostly refinancers and rate watchers who had already had a purchase in mind, okay? The broader population of potential buyers did not suddenly decide that 5.98% solved all of their affordability problems because it doesn't solve the problem by itself, right? The median home price is still elevated. Wages are growing, but not fast enough to close the pricing gap. Sellers who had a 3% mortgage are not listing just because buyers can now access 5.98% loan money, okay? Here's another thing. The geographic dimension of this whole conversation is real, and I think it's very underreported, okay? Here's what I mean by that. The data is not uniform as a national story. Florida home prices are down 2.3% year over year. Colorado is down over 1%, closer to 1.5%, and Utah is somewhere around a point. Okay. These are markets that boomed during the pandemic migration, and they absorbed a lot of new supply. Those markets are softening right now. And then meanwhile, on the other side of the coin, you have New Jersey up almost 6% year over year. Illinois is up almost 5%, Connecticut 5.2%. The Midwest and Northeast are holding up because they never fully overbuilt. Their price points remained relatively consistent and affordable for their market anyways, and their job markets remain stable. An agent in Phoenix, Arizona, and an agent in Columbus, Ohio are operating in fundamentally different markets, and they should be having fundamentally different conversations with their clients. So, what does all of this mean for agents and how they should be operating right now? I'm glad you asked. I think it comes down to three things. Number one, stop building your pipeline strategy around rate chasers. The clients who are actively buying right now are not buying because the rate environment is attractive all of a sudden. They are buying because something in their life requires it. A divorce, job relocation, a parent who needs care, retirement, a growing family. There's a lot of reasons that they are buying, but these are necessity buyers, and their timeline is set by life, not by the bond market. That matters for how you prospect to people, how you position your value, and how you run your consultations. If you are still leading with rates are finally coming down, you are not speaking to the actual buyers who are making decisions right now. You're speaking to people who are still sitting on the fence, which is fine. We need to build the pipeline down the road, but understand that converting fence sitters into committed buyers in this environment is a long play. The necessity buyers are where your near-term business lies. Number two, the pricing conversation with sellers has to happen before the spring listing market hits. Sellers are sitting on equity from the pandemic run-up, okay? Their reference price point is home values from 2021 and 2022, the prime COVID years, okay? The buyer's reference point, however, is today's actual rates, today's actual market, today's actual payment shock, okay? Those are very different numbers and very different conversations. With 64 days on the market, on average across the country. Homes priced wrong are not just sitting, they're doing some other things. They are building a stigma. Buyers are asking what's wrong with it. Price reductions become the only lever you end up having. Having an honest pricing conversation now before you have the listing is how agents protect their clients' net outcome and their own time, right? The agents who don't have that uncomfortable conversation up front, you are on a collision course for it with your 30-day pricing review, okay? The third thing we need to be aware of is you need to know which market you are actually in, okay? If you're an agent in the Sun Belt, the story is price correction in process. There's more inventory, softer demand, buyers have negotiating leverage, right? Your clients need to understand that pricing is more important than timing right now. Now, if you're in the Midwest or Northeast, you're in a tighter market that hasn't really experienced the same correction that we're seeing across the country. Inventory is still very lean, demand is relatively stable, and the pricing conversation is completely different. What I'm trying to say here is you cannot have the same market narrative in both of those environments. The national news is a blended average that describes no market correctly. Okay, keep that in mind. Now, here's what I keep coming back to throughout this entire review. The market is not broken. It's complicated. Damn, it's complicated right now. Complicated markets are what separate agents who are paying attention from the agents who are just, hoping for conditions to improve. That's not the way to run a business. The February jobs market, the oil prices, the brief moment when rates touched 5.98, bringing the market alive, only to have it fall asleep when rates tick back up. All of that is telling a very coherent story if you just read it right, okay? And here's what the story is. This market rewards specificity, okay? You need to know your geography. You need to know who is actually buying, know what the pricing data is saying in your zip code, and you do not need to sell a national average to a local client, okay? That is your edge right now. That's the signal, and it's available to every single agent who's actively paying attention, all right? If something I said today connects with how you're thinking about your business, I'd genuinely like to hear about it. Drop me a comment, send a message. I'm here, all right? And I will see you all next Sunday, coffee and all. Let's go get it.